Hello, I want to welcome everyone participating in today's webinar, Maximizing PPP Loan Forgiveness. My name is Stephen Boisvert, and I am a tax manager at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will also be asked to recall these words in order to receive credit. Please write down the CPE words when they're given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download after the webinar is concluded. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan McKelveen at nmckelveen@grfcpa.com. Today's learning objective is to provide an overview of PPP loans and the methods to maximize loan forgiveness. One CPE credit is available for this webinar. I'd like to introduce your presenters for today's webinar. Mr. LaCastro is the Nonprofit Tax Director at GRF CPAs Advisors. Mr. Turner is the Director of Tax, and Ms. Litwack is a partner in the Outsourced Accounting and Advisory Services Department. I will now turn over the presentation to Troy.
Thank you, Steve, and welcome everybody to our presentation today. So we have a brief agenda here. We're going to cover qualifications and loan forgiveness overview. We have some salary and wage reduction rules that Dick's going to cover, and Eleanor is going to provide some tools and resources for tracking the loan forgiveness. So I'll get us started today with a brief overview. I'm sure those of you that have already applied and received your funds may know some of this information, but I think it's good to provide some context and also touch on some of the newer elements that have come out in the last week or so related to the Paycheck Protection Program. So the PPP program was enacted through the CARES Act, and it's designed to provide loans starting April 3rd, 2020 through June 30th, assuming there's still loan funds available at that time. A maximum loan amount would be up to $10 million, and the amounts of the loans not forgiven would have a 1% interest rate. And the program itself is generally designed for employers that have 500 or fewer employees residing in the US. There are some exceptions to the 500 employee limit that we won't touch on, but generally speaking, that's the primary target for the loan program. It's obviously intended to help companies that are impacted by the COVID-19. The PPP loan is based on 2.5 times the borrower's average monthly payroll costs. The original budget or amount that was carved out for the program was $349 billion. That money ran out within about 2 weeks. And then some additional funding was put in place, $310 billion, which began April 24th. And as of this morning, there are still funds available in that second tranche of monies. So for those of you on the call who are evaluating whether or not you want to apply for the program, there are still funds available as of today. So I want to touch on some additional qualifications related to the program. So after the first chunk of money was applied for and people began to receive their funds, that information, so recipients of the loans can be public information, or it is public information. I'm not sure if it's under a Freedom of Information Act, but Basically, in the news, you saw that some publicly traded companies and some larger businesses received some of the larger loan amounts, and there was a backlash related to that. So as a result, they added FAQ 31. So part of the guidance for the program is a frequently asked questions section that's on the SBA website. And throughout this whole process, they've been adding FAQs. It seems like every other day or so, they seem to add some. I believe we're up to 45 FAQs now. So I certainly advise that you go visit the website. We have a link to that on our website as well. So you can get some of the most recent information and guidance is being put out through these FAQs. So back to FAQ 31, as a kind of a public backlash to having these large publicly traded companies applying for and receiving the funding, the SBA and the Treasury wanted to emphasize that as part of the loan application process, you are making a certification in good faith that the PPP loan is necessary to continue your ongoing operations, taking into account the organization's current activity and your ability to access other sources of liquidity. So there is an emphasis there to make sure that people take a step back and make sure that they do need the funds because they're making a certification as part of that loan process. And there was a feeling there that some of these larger publicly traded companies that had access to capital markets didn't meet that criteria. So some of those organizations have given the money back. So the part of the FAQ 31 was they provided an avenue for large companies who, upon further review, didn't qualify to get the money to give it back by the initial due date was May 7th, but they've extended that, so that wouldn't have been relevant for this discussion. However, they, under FAQ 43, recently extended the due date to give loan proceeds back to May 14th. So there's a couple days left in case there's anyone listening who, upon further review, feels like they may not need the PPP funds. So, so a key item here is to keep in mind that everyone who receives the funds should be prepared to justify their basis for making that certification on the application. So you should have some projections, spreadsheets, narrative, board meetings, something that shows that you've documented your need for the program, just in case the SBA asked for that as part of the forgiveness process. Right now, we don't know if that'll be part of it or not, but the SBA did mention that they were going to provide more guidance on how they will review certifications, but we haven't seen any of that guidance yet. So, which is a little disturbing given that the payback deadline is 2 days from now. But one other thing to note on this slide is that a part of the fallout, from the backlash was the Treasury said they were going to specifically review all loan amounts above $2 million. So if you're an organization that has a PPP loan of $2 million or more, before that loan is forgiven, the SBA is going to do some sort of review of a review. We don't know exactly how in depth that will be, but be ready for that. So in order to qualify for forgiveness, so the CARES Act does provide that the PPP loan can be forgiven 100% of the amount borrowed plus interest if you meet certain criteria. And basically, you have to spend the money to cover payroll costs, mortgage interest, rent, paid on leases, utilities over an 8-week period, otherwise known as the benefit period or the covered period. So in addition to spending the funds on those costs, the organizations also needs to maintain their employee headcount, and also for employees that have compensation below the $100,000 cap, those employees' levels of earnings also need to be maintained at a certain level, and not more than 25% of your loan proceed can be used for qualified non-payroll related costs. So another way of saying that is 75% of your expenses must be related to the payroll costs, and then 25% can be the mortgage interest, rent, the utility expenses, in order to get 100% forgiveness. So for the portion of the loan, after you go through the mechanics and the forgiveness process, if you have a portion that's not forgiven, then that actual loan is payable over 2 years, again with a 1% interest rate, and there's a deferral on the payments for 6 months. The Act provides that the loan, the forgiven amount of the loan will be tax-free for federal income tax purposes. So that was a very important provision that was put into place as part of the program. Also, the 8-week period for tracking expenses begins when you receive the loan proceeds, and that's outlined in FAQ 20. The AICPA has sent some recommendations to the SBA to allow for different start dates, ones that align with the next beginning of the next pay period, or potentially to begin, once stay-at-home orders are restricted in the state where that business is located. However, those recommendations have not been addressed or acknowledged by Treasurer SBA. So current guidance would be based on the FAQ 20, which is the 8-week period. Again, for tracking expenses begins with the date you receive your loan proceeds. So when the program was initially put in place, and it was noted that the forgiven part of the loan would be tax-free for federal income tax purposes, I think everyone assumed at that time that the expenses related that were paid for by the loan proceeds would be deductible, kind of as usual. But it quickly came out that there's a provision in the IRS code, code section 265, that has been in place for a while, that basically states that when you pay expenses with tax-exempt income, that those expenses are generally not deductible under regular law, under 265, and this prevents a kind of a double dipping or double benefit. So there was some confusion as to whether or not Section 265 applied to the PPP loan forgiven amount, and whether that was the intent of the law for that code section to apply. And recently the IRS came out with notice 2020-32 that confirmed that Internal Revenue Section 265 does in fact apply, and that the expenses paid for by the forgiven loan amount would not be deductible. So there were some members of the Senate that felt that did not follow the intent of the original law. So they have introduced a bill called the Small Business Expense Protection Act of 2020 that, if passed, would override IRS Notice 2020-32 and Section 265 and make the expenses tax deductible again. But at this point, again, it's just a bill that's been introduced in the Senate, and it hasn't been passed. So the current guidance is that those expenses are not deductible as of now. So hopefully they'll pass that law and they'll become deductible at some point. But right now they're not deductible. So I want to just quickly cover what the Paycheck Protection Program means to self-employed persons that don't have employees. So generally speaking, when you apply for your loan, you use your loan amount is based on net profit on your 2019 Schedule C, and the forgiveness is also based on the same net profit from your 2019 Schedule C. Some general requirements for self-employed persons would be that your self-employed business had to have been in place as of February 15th, 2020, and the principal place of residence of that self-employed person would be in the U.S. Oddly enough, there's no guidance for how someone applies, what documentation someone would provide for the loan or for the forgiveness if they started their business sometime between January 1, 2020 and February 15th, 2020. So hopefully they'll provide some guidance for those individuals. But for now, if your business was in operations in 2019, it's pretty clear you provide Schedule C, your Schedule C for 2019 for both the loan amount and the forgiveness amount. And in order to get forgiveness for those other expenses, the non-compensation piece, so for the mortgage interest and utilities, you would have had to have had those expenses on your 2019 Schedule C. So if you didn't have those other expenses on your 2019 Schedule C, but you had expenses in 2020, unfortunately, you can't use the 2020 expenses for forgiveness purposes if you didn't have them in the prior year. So quickly, self-employed persons who are partners in partnerships or LLCs, your Paycheck protection program is all handled at the entity level, not at the individual level. So there's nothing to do related to the PPP program for you individually. So we've just listed some definitions here related to payroll costs and covered rent. So we won't read those, but just want to have the slides here. On the next slide, I do want to cover one definition that came out recently in FAQ 33. So in order for you to count an employee's payroll costs in the loan application process or for forgiveness, that employee's principal place of residence must be in the United States. And the original guidance didn't have any definition of what principal place of residence meant. So they added FAQ 33 that references IRS Code Section 121 for the definition of principal place of residence, and that is the code section that deals with the gain exclusion on the sale of your principal residence. So often the IRS, when they or the Congress, when they pass a law, they'll grab a definition from some other code section. So they've done that here. My interpretation of it generally is that if you have expat employees, so employees who live and work overseas on long-term assignments that last for more than a year, that you wouldn't be able to count their compensation in the loan application or the forgiveness calculation based on this definition. So we now reached our first polling question.
Yeah, we've reached our first polling question, which is, has the recent emphasis on the certification in good faith, coupled with the loss of the deduction benefit for expenses, caused your organization to consider giving the money back by May 14th or not applying for the loan at all? A, yes, we have or will give our loan monies back. B, no, we need the funds. C, unsure, we are currently evaluating the issue. Please take a moment to answer now. While participants are submitting their answers, I'll provide the first CPE word of the day. The first CPE word is loan. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is loan, L-O-A-N.
Okay, great. Thank you everybody for participating. I'm not surprised to see that the vast majority of you need the funds. That's what they were intended for. So happy to hear that most everybody's feels like they can keep it and keep applying for the forgiveness. So now I will turn over the presentation to Dick LaCastro, who's going to cover more details on the actual calculation.
Thank you, Troy, and good morning, everyone. Thank you for participating. It's certainly been an interesting several weeks on all sorts of fronts, including IRS, Treasury, and SBA guidance. We were hoping that we'd have more detail around the forgiveness calculations. I was reading an article this morning in the tax press, and just to give you a couple of things to set up the context here, and then we'll drill into the details. You know, the IRS was supposed to give some more guidance on the PPP loan forgiveness process, and I believe the deadline was April 26th, which obviously has come and gone, and we're a bit past that. There has been some consternation that the underlying requirements, and I'll talk about the 75-25 requirement in a second, that the underlying FAQs and some other things are actually in contradiction or maybe not consistent with either the law or congressional intent, as Troy had talked about on some things there. The SBA Inspector General on Friday issued a report that found that the requirement that 75% of the PPP loans be used on payroll, that this was did not align with the allowable use requirements of PPP loans under the law created by the program. In response to that, Mnuchin, Treasury Secretary Steve Mnuchin, did say that he was willing to work with Congress if they wanted to change that rule and tweak it to meet what I guess is the perceived intent there. So that's one thing that has really hampered, I think, some of the issues that we're facing here. So I mentioned the 75% rule. And the way they came up with this, and this was in the interim final guidance there, that it was issued, I believe, in April 24th, that basically described how they came up with the 75% rule. And the idea is to keep people on payroll, which is what the explanation came out to be. So they said, well, 8 weeks of payroll over 2.5 months is basically 75%. And so in that case, we want you to use primarily 75% of it for payroll, 25% for non-payroll costs, rent, interest, et cetera, utilities. And as Troy had mentioned, we've got some of those definitions in the previous slide. So if your average monthly payroll declined since the 12-month period used to compute it, you will have trouble reaching the 75% for the 8 weeks. And of course, there's a lot of economic conditions that may have required organizations to lay people off, and we'll talk about some ways to maybe ameliorate that later. But if your payroll costs did decline, you may have trouble meeting the 75% payroll costs. One thing that we've heard, and again, we don't have rules that confirm or deny this one way or the other, whether or not you can use a bonus to the rank and file, again, those people under $100,000, to boost up your payroll costs during this period, you know, and some of it may actually be legitimate, recognizing that they're working in difficult conditions, working while trying to balance, obviously, concerns at home. But that has been one way to suggested that may be able to help do that. But when all else fails, even if you don't achieve the total forgiveness, you have a 2-year loan at a 1% interest for the amount that is not forgiven. So that's really when we talk about the 75% rule, and we'll see if that changes, which my sense is that may get tweaked as we go forward. Whether or not we can meet that, it's still all is still not lost. You still come out with a loan at a very favorable interest rate. So when we talk about how your forgiveness can be, can be reduced, so we take the first step is what are our costs for payroll and rent, and making sure we meet the 75-25 split there. The way I read it, although you can say it a couple of different ways, is that you can use, the way I read it is you can use more than 75% for payroll because that was the intent, but no more than 25% for non-payroll costs. So I've seen some commentary that maybe interprets that a little bit different, but I think that comports with the reading of the law. So once you get your forgiveness amount for those approved costs that we talked about for the 8-week period, that's your maximum forgiveness. And then we've got to determine whether or not any of it can be reduced. And so there's two things. There's a headcount reduction. I have less FTEs as compared to a couple of periods that are my baseline, or I have a reduction in payroll. So I've got people there, but I've reduced their pay to a point that it impacts my forgiveness. And we'll talk in detail about both of those. So once we get the forgiveness amount, we look at the headcount reduction. So we're going to measure our number of FTEs during the 8-week period. Okay, and the average FTEs per month is calculated based on the average number of FTEs for each pay period falling within that month. So we look at the pay period falling within that month. Now, some organizations may have some folks on a semi-monthly and some people on weekly. So I think the way I would do it is to look at each group of people, calculate it based on the pay period, get the average, and then obviously average them together. And we're going to take our 8-week covered period, as Troy mentioned, the term we use for the 8-week period following the origination of the loan, and we're going to compare that to FTEs we had in either one of two baseline periods, either February 15th, 19 to 6/30/19, or 1/1/2020 to February 29th, 2020. So if our FTEs during the covered period was less, so we take the ratio of FTEs in the covered period over one of those two, and we would have a reduction in our potential forgiveness. So let's talk about that. I'll give you an example here as we go to the next slide. So just in big picture, if we had 10% fewer FTEs in the 8-week period, our loan forgiveness is proportionally reduced, there, in my example, by 10%. One thing to remember as we contrast that with the salary or wage reduction, so this is a percentage reduction. The salary and wage is $1 for dollar. So just to keep that in mind as we compare those two. So the calculation, a couple of points before I give you an example, the calculation of FTEs has not been defined for these purposes. Now, in general, the calculation is the employee's scheduled hours for a week divided by the employer's total hours for a full-time week. Typically, that would be 40 hours. If you're scheduled 40 hours, if that's what you generally work, and the employer says 40 hours is full-time, then you're 1.0 FTE. Some workplaces will have 37.5 and may have differently. There's a couple of, Troy had mentioned AICPA recommendations, I think, as it related to the pay period. And there's some other recommendations, and I encourage you to check out their website for some of the recommendations they've made. A couple of things that they have recommended is using the Affordable Care Act 30 hours a basis for full-time, and advocating a wage-based proxy. And what that means is for some workers, sometimes full-time workers, there's no real hours collected. We don't track their hours. We just know that they're full-time and they're exempt and they're working as much as they need to. Or if you do piecework, you get paid by something other than the hour. Hours may not be collected. And so they've got some nice suggestions about some answers to those. But again, we haven't seen any detail. Hopefully the SBA will consider those along with some other comments they've got. So just big picture, we calculate our payroll costs and our rent, utilities, et cetera, to be $500,000 during the covered period. That's our forgivable amount of our loan. But our FTEs in the period, either the February 15th, 2019 to June 30, 2019, or the January 1, 20 to end of February 2020, has dropped. So let's say it drops by 10%. So it goes from 110 FTEs to 99 FTEs. We take our $500,000 forgivable amount and we multiply it by the ratio of 99 over 110, which would get me to, if I did my math correctly, a reduction of $50,000 or $450,000 as my potential forgivable amount. So that's the FTE calculation. The other way that we may be able to have our forgivable amount reduced, as I mentioned, was if we have a reduction in wages. And the reduction in wages has to be greater than 25%. And the way I read it, it's calculated on a per employee basis with a couple of tweaks here. So first of all, we're going to identify all our employers during the 8-week period that you employed at any point during 2019 and did not receive during a single pay period during 2019 wages or annualized rate of pay more than 100,000. So those what we call the below 100,000 people. So those are the folks. Apparently, we can reduce pay for the above 100, and that doesn't affect our forgiveness amount. But it's the people below 100,000 that we believe are the ones that we have to measure the impact of. Now, what we don't know is what is the impact of, let's say, during one pay period, we paid one employee a bonus, and that on an annualized basis put them over 100,000, how that would impact that. We don't really have an answer to that question right now. But as I mentioned in the first bullet point, there is no reduction for employees, the way we read it, that did not work in 2019. You only look at the workers in 2019 is how we think that will come out. Now, how do we calculate it? So the way the law says is we compare wages during the first quarter of 2020, preceding when you got the loan. So if you got the loan in April or May, it's going to be the quarter from January to March of 2020, wages paid there versus wages paid during the covered period. And that's really the extent of the detail when we talk about how we do the calculation for that. Now, obviously, if you pay somebody for 12 weeks in the first quarter, they're going to have a reduction in pay if you're only paying them 8 weeks in the covered period. So that's why the AICPA, I think, has suggested that when you do this calculation, you do an average salary per week for the first quarter. To do that calculation, you're looking at the average salary per week when you're doing that, so that you get a true comparison as to whether or not wages actually dropped. So if you determine each employee's average salary during the first quarter, and then the way this calculation is phrased, 1/8 of the total salary you paid during the 8-week period is at least 75% of their average wage during the first quarter, there's no further reduction in loan forgiveness. Basically what that says is, doing this calculation, we did not reduce wages by more than 25%. Now, if you had a reduction in salary by more than 25%, then dollar for dollar, the portion beyond the 25% reduction is the amount the forgiveness is reduced. So again, I mentioned that the FTEs was a percentage. This is a dollar for dollar reduction. And my understanding is you would look at any employee that had that reduction there. As I mentioned, we're still waiting on guidance on the exact methodology or methodologies that will be acceptable. As I mentioned, there's the link to the website on some of the AICPA recommendations. It'll be interesting to see what the banks do in the meantime with lack of guidance from the SBA. As I mentioned, they missed their mark of April 26th. And they also mentioned that on the return of funds that Troy had mentioned earlier, they're supposed to issue guidance before the May 14th deadline for the return of funds, and here we sit at May 12th at 11:35, and I don't think anything has come out yet. So just to wrap this up on some relief provisions, if you did have reductions, because remember, not a lot of people knew what was going to happen. They had to lay off people because they didn't have funds, and they had to shut their doors. And then the PPP loan comes along, and they say, okay, well, geez, I'm going to get a reduction in my forgiveness because I had to lay people off, and then I want to hire them back. So in the headcount reduction, if by June 30th, 2020, you bring your FTE levels back up to where they were, at February 15th, that should excuse whatever reduction in forgiveness was attributable to the drop in headcount between February 15th and April 26th, which is basically 30 days after the effective day of the law, I believe is why that is in there. So it says the employer has eliminated that reduction in FTEs. So two things on that is, we don't know if there's going to be guidance to say, well, you just can't put people on the payroll at the end of June, fire them in the following month in July, and still get this relief benefit because you didn't really do that. I know some people had commented, well, can't I just hire them back at the end and then I'll be okay for a little while? So we don't know about that. But one good thing we do know is there's a lot of people that may not be coming back to work because of as I've heard it described, the unemployment on steroids, and they have children at home, they have somebody who's sick, there's lots of things going on in their lives, and they say, I'm making more money or almost as much money by not going to work and collecting unemployment. So there was a frequently asked question number 40 that said, loan forgiveness on the employer side will not be reduced if a good faith written offer to rehire the laid off employee is declined. So that's one of the things that may help some employers who try and rehire during this period. Now, on the salary and wage reduction, similarly, last point on this is that if the wage levels of those people that are below 100,000 are brought to at least the existing level on February 15th, that should excuse any salary or wage level reductions that occurred during the period from February 15th to April 26th. So again, the statutory wording is the employer has eliminated the reduction in salary and wages by the June 30th. As a practical matter, your loan, your 8-week period could run out before the June 30th comes up. What I've heard suggested and what I think will be the answer there is that we just wait to apply for loan forgiveness until we can prove that we've done that. So, and I think with that, I believe we have our second polling question.
Yeah, we do. Have you or your organization done a preliminary calculation expected PPP loan forgiveness? A, yes. B, no. C, we were waiting for further guidance from the SBA before we do our preliminary calculation. As you take a moment to answer that question, our participants, the second word for the CPE credit is payroll. If you want to receive CPE credit, please continue to jot these words down because you'll need them for the survey following the webinar. Again, the word is payroll, P-A-Y-R-O-L-L.
Okay, and then looking at the results here, have you calculated expected loan forgiveness? Good to see that about 58% have. 12% said no, and 30% is waiting additional guidance. So that kind of comports with what we think a lot of our clients are doing is, at least doing a preliminary calculation and tracking to see whether or not they would qualify. So that's good to know. And I will now turn it over to Eleanor for our last section on some of the record keeping requirements and good things to do to maximize your forgiveness.
Thanks, Dick. So even with all this uncertainty out there and as we wait for more guidance, what we could do now is start gathering the documents that the lenders are going to need for the forgiveness application process. So we've listed a few of them here. We know there's going to be a formal application that the SBA releases, and the lenders are going to be required to collect that from each PPP loan recipient. Don't know what that'll look like yet, but it should be released in the next few weeks, and then that'll be sort of the summary page of the whole application package. And then if you think of the full-time equivalent and headcount assessments that Dick went through and the wage analysis, all of that is going to need to be documented. So something showing the current number of FTEs you have compared to your baseline period, a listing of your employees who are under 100,000 in the current period and what their wages were in 2019. All of that is likely going to be expected to be submitted to the bank. And if you use a payroll company, whether it's ADP or Paycheck or maybe a medium or smaller one, we do expect that they'll come through with a canned report package, similar to the ones that they provided in the loan application process. We expect that for the forgiveness piece, you'll also be able to just pull a report that documents all these pieces in the right format for the forgiveness package. And another thing to be mindful of is those non-payroll costs. So you've got the payroll reports and the tax filings to document payroll, but then you're going to have the rent and the utilities that you're going to need to submit for as well. So if you generally pay these things by ACH and maybe you don't have the documentation on hand, now's the time to start gathering that. So if your landlord typically doesn't bill you for rent, you should ask them to send you an invoice for the months of rent that are paid during the 8-week period, or even incurred during the 8-week period, depending on which ones end up being acceptable for the forgiveness piece. So go ahead and start filing all that now and gathering it. Same goes for health insurance. If that's pulled by ACH, you might want to start gathering the backup, 401k, and anything else that you're using your loan on. I think Troy mentioned this earlier, that you could use the loan on lease agreements and utilities for service agreements in place prior to February 15th. So if you happen to sign a new office lease in March, or you replace your phone lines after that February 15th date, the loan cannot be used on those. So what we will expect for the forgiveness package is that they'll want to see proof that these agreements were in place prior to February 15th. So for a rent agreement, that would be the lease that was signed, and you could show the date that preceded February 15th. For phones and other utilities, probably a bill will suffice, but just keep that in mind as being part of the package. Another thing, and it's not on this list, but there might be a collection of the documentation showing you needed the loan in the first place. So as Troy mentioned earlier, the additional guidance came out clarifying that you need to return the funds by May 14th, or show somehow that you're using them for the authorized purposes and you didn't have other funds to cover those things. So you might need something on file. It's best practice to document it anyways, but that may or may not be part of the forgiveness package, sort of showing your need for the loan in the first place. And of course, there might be some other things that lenders require, even, especially if there's a bit of haziness left at the end of this. Each lender might have their own package, some lengthier than others, based on the way they interpret the SBA guidance and everything else that comes out. So we've gotten a ton of questions on whether a separate bank account is required for the PPP funds and the related activity. Currently, there's no requirement to keep the PPP funds segregated in their own bank account, and we don't expect there to be one. Just based on the way that the calculation works, it's not practical to have everything run through the bank account so that your PPP forgiveness equals your balance in that bank account. So there's no requirement to keep it in a separate bank account. And I know many of you actually have them in a separate account, whether you applied for it with a different bank, you didn't use your current bank, or whatever situation you're in. So what you want to do now is fund your current checking accounts, the ones that fund your payroll and bills and rent and other stuff, fund that via bank transfers from your PPP checking account into your normal checking account, and that should do it. And then aside from tracking it in the bank account, there's also this option of tracking it on the books. So again, not a requirement, but might be best practice and maybe the smoothest way for you to track down to the transaction level what's being funded by your PPP loan. And there are different options here, which the answer for you will really depend on what type of organization you are, how complex your chart of accounts and other dimensions are, what bookkeeping system you use. So there might be better options depending on those types of things, industry and accounting system. But you could see that we've listed a few here. There's always the option of just creating a separate general ledger account to track PPP stuff. So for example, you have your normal salary and wage expense account, and now you would go ahead and add salary and wages dash PPP. That may or may not work depending on how simple your chart of accounts is. You might have a situation, for example, if you're using your chart of accounts to track direct labor versus indirect labor, or maybe you're doing labor by department. If you're now coding that stuff to a separate PPP funded labor account, you're taking away from all the natural information that you are using your chart of accounts to track. So just be mindful of that when you're adding new GL accounts if you're trying to track the PPP on that level. And same goes from your project for your project and job type dimensions. So if you're doing job costing, you got employees working on projects. If you're now creating a PPP project, you might be taking away from your job costing system by now coding those wages to a PPP project. So just make sure that if you're adding PPP trackers in your system, that you're not taking away from your normal set of books and the reports that you need and the typical outputs that you get. One really good option is if you have a customer or funder dimension that you use. So if currently your books are set up to track transactions down to the customer level, so who's funding this, where did this money come from, that might be a good place to add a PPP customer because it'll roll right into your system. And then later when you want to pull out a report, you filter it down to that customer dimension, tracking it down to the PPP level, and you can get an automated report showing everything that was tagged there. And again, depending on your books, you might even have another dimension available that can track this thing outside of your normal dimensions that you use. So aside from tracking things on the bank account or using your transaction tagging, there's good old Excel and tools that you should maintain now if they apply to you. So Dick walked you through the headcount and the wage analysis. If you didn't maintain your staffing levels, or for whatever reason they fluctuated between last year and this year, or wage levels are going up and down for either COVID or non-COVID related reasons, it's best to just keep these trackers with the calculations that Dick walked you through, just to make sure that you're on top of the projected forgiveness and maybe trying to get ahead of possible reductions and ways to mitigate that. So if you were to put together a headcount analysis, you would compare your FTEs now to the FTEs in whatever baseline period you choose, whether it's those 2019 dates or January through February 2020. There are a couple of different definitions of how to calculate an FTE, what goes into that calculation, which there's no straight answer on, but as of now, we could tell you to just use a consistent calculation. So whatever methodology you're using to define an FTE in the 8-week covered period, you're going to use the same calculation for your baseline period, and then you have apples to apples, so that later down the line, if a different definition is released for how you calculate an FTE, the analysis might come out the same in terms of reductions because you were consistent in your original definition. And then for wage analysis, this one will be more in depth than the total FTE analysis because you do have to go employee by employee for those that are employed during the 8-week period, and also, as Dick mentioned, those that are earning less than 100,000 on an annualized basis. So you want to list those and then compare their average weekly rate between the first quarter in 2020 and what their weekly rate was for the 8-week period covered by the loan. So in this scenario, employee A, their wages were reduced from $1,200 a week to $1,000 a week, but they're still being paid at 83% of what they used to be paid. So because they weren't reduced by 75%, there's no impact on the loan. As opposed to somebody else, employee B, who is now earning $1,000 as compared to their previous wage rate of $1,600, they're only earning 63% of what they used to earn. So that would trigger a forgiveness reduction dollar for dollar with that delta between the 63% and the 75%. So if you're ahead of that now and you're tracking it, whether it's week after week or a couple of times a week, depending on the way that things fluctuate at your organization, then you might have an opportunity to reinstate wages or take other steps to maximize your forgiveness. And then just a basic forgiveness projection. Of course, it's not basic because there are so many scenarios now based on assumptions that are out there. Is it cash or accrual basis? There's just tons of questions in terms of specific situations that everybody has that doesn't fit so nicely into the current definitions. So as we wait for clarification, the best thing we could do is put together a projection based on what we know. And we might have different versions of this. If all of your payrolls, like an 8-week covered period is expected if you're semi-monthly to cover 4 pay periods, but depending on the date that the first disbursement came in, it might only cover 3 pay periods. So there are many assumptions there. Could we squeeze in that 4th pay period? Could we apply it to the pay period that we paid a couple of days before the loan was received? You're going to want to track all this based on different versions, just to make sure that you're on top of potentially what can or cannot be forgiven. It's definitely, it's complicated to run multiple versions of this, but I think leading up to when new information starts to come out and we could cross off certain assumptions and scenarios that we had, this will get easier and easier, hopefully, as we get more clarity. So in terms of recording the actual loan proceeds on your books, many of you have probably already created these new GL accounts to capture the loan activity. So when the funds are received, they're on your books as a loan until the forgiveness piece occurs, in which case it turns into revenue. So you're going to need a new general ledger account for recording the liability on your books, same place that you would put another line of credit or another loan. So you just create a separate liability account to capture the new PPP loan. And if you have a larger loan, a couple $1 million, the interest expense might also be material and should be accrued every month. For a smaller loan or other situations, you might not have to go through that. But for larger loans, you would accrue the interest at 1%. And then when the forgiveness comes through, that's when the loan turns into revenue. Both the principal and the interest are forgiven. And that's when you make that journal entry to move it to revenue. And then anything that wasn't forgiven will just remain on your books as a loan balance until it is forgiven, or paid back, rather. It's important to note that the banks are going to have 60 days to make a decision on loan forgiveness. It's quite a lengthy period for, obviously companies are relying on this money and the fact that they probably or may not have to pay it back. So just plan for now. Even, if the banks are taking their full 60 days, you might submit the package now and not find out till 2 months later if that's forgiven or not. So that changes the way you're managing your cash flow. You're just going to want to manage the risk around not knowing the answer for potentially 2 months. And then once they do make that decision, the SBA pays the funds directly to the lender. The loan is closed, it's forgiven, and we can move on. I think, in the absence of more guidance coming out, we might have a similar situation to what we had when we applied for these loans, which is that every lender kind of makes their own interpretations. So you might have different math going on depending on your bank. But we'll see. We just have to see how specific the SBA gets and whether they'll leave room for lenders to make their own decisions. And finally, I don't think we need to point this out to this audience, but any misuse of the funds for unauthorized purposes, you'll have to pay them back. They're subject to penalties, etc. And with that, I think it brings us to our last polling question.
Yeah, thanks, Eleanor. Is your organization utilizing a tracking system for PPP usage on the books? A, yes, using the general ledger accounts. B, yes, using another dimension like project, job, class, customer, etc. C, no. D, unsure. Please take a moment now to answer the question. While participants are submitting their answers, I'll provide the final CPE word for the day, which is expense. If you want to receive CPE credit, please continue to jot these words down. You will need them for the survey following the webinar. Again, the final CPE word is expense, E-X-P-E-N-S-E. And before we wrap up today, we want to take some time to answer a few questions submitted by our online participants and any others from the room. I think we've received about 24 questions So we're not going to have time for all of them. If your question is not answered, please take a second to just write it down in an email and send it to one of our presenters today, and we should be able to get you a response on that. Eleanor, did you just want to take a second to look at the quick poll and see what the results are there?
Yeah, it looks like many of our participants are using general ledger accounts or some other dimension to track the loan on the books, which is a great automated way to be able to pull out a report later when it's needed. And the banks will probably be happy with this as well. So that's really good to see. Again, it's not currently a requirement, but certain banks might ask that you do have this tracked on your books. So you can always set it up after the fact, and many of you already have it set up now.
Great. Let's see, the first question that we have is, what should I do to document that I tried to rehire an employee, but the employee refused?
Hi, Steve. This is Dick. I'll take that one. I mean, I think the FAQ goes into some detail, but you should just make sure you had a valid. I would do it in writing, valid written offer of employment, and document that they had refused to accept being rehired, and of course keep that in your records as it relates to your forgiveness, because I think the bank may want to see that documentation. But it has to be a valid offer. It can't just be something that informal. I would, again, make sure you get it in writing in some way.
Great. This one was submitted. Have you guys seen any guidance on whether cell phones would be considered utilities?
Again, this is Dick. I know that when they talk about utilities, they do mention in general electricity, gas, water, telephone, internet access, and transportation. And I think we also had a question about what constitutes transportation for these purposes. And unfortunately, other than that language, I don't know that we have any guidance beyond that, because we have some questions about what about, if I'm talking about rent and utilities for my office and I have landlines versus I reimburse my employees or their cell phones, and do you roll that in? And, we've struggled with that question, but unfortunately, I don't know of anything specific yet on that. So I would track those expenses until we get better guidance, and make sure we have them in case we need them to roll into our forgiveness.
Okay. Another question that came in, and I think, Eleanor, you felt like you could cover this one, was, can more than 75% be spent on salary and still be forgiven? Or is it a strict 75-25 split between salary and eligible overhead expenses?
Right, it's a good question. So the 75% is the minimum that you have to spend on salaries, but in theory, you could spend 100% of the loan on eligible payroll costs and still have it be forgiven. So as Dick said it earlier, you cannot spend more than 25% on rent or utilities or that other stuff, but you have to spend at least 75% or more on salaries and payroll related costs.
Got it. Another question, when does the clock start ticking once you've received your loan? And by when do we need to spend down the full amount?
So this is Troy, I'll take that one. So the guidance in the FAQ was that you need to start tracking expenses the date you receive your loan proceeds. So that's when the clock starts ticking for your 8-week covered period. So so from that point on until for 8 weeks, I mean, those are the expenses. And I know Eleanor mentioned this, whether we're dealing with incurred/accrued versus cash basis, we're not 100% sure. But we, at this point, know it's as of the date you receive the funds, you begin tracking expenses.
Okay. We may finish up on this one. Which expenses can or should we spend the loan on to ensure that the entire amount is forgivable?
This this is Dick, and I think to piggyback on what Eleanor had said, it was primarily, at least the intent that's been expressed is primarily to keep people on payroll, because if we think back just 8 or 10 weeks ago, with nobody knowing what's going on, everybody's sitting there saying there's going to be massive layoffs in a lot of industries, and certainly there were. And so I think the primary intent is to keep people on payroll. I think you can spend it primarily on payroll. Now, there are questions about, and we've gotten some other questions similar, is, can I pay bonuses? And I think that's still open. But if my regular bonus period is in June, and it's a regular thing that we do, and you can show that it's reasonable, I would certainly argue that's part of my regular payroll during this 8-week period, and I should be able to do that. But just saying, okay, I've got, $200,000 left that's not going to be forgiven, so I'm just going to give it out to my employees because it's free money. I would expect the SBA and Treasury to issue guidance that would probably prevent that. But payroll is certainly your best bet there.
Good.
And Eleanor, I don't know if you want to add anything to that.
Yeah, I agree with that. It's interesting to think of whether they'll issue guidance on bonuses and whether the nature of the nature or the frequency of the bonus has a difference in whether you can include it or not. So we have to wait and see what comes out around that.
Great. Well, thanks to our presenters for, fielding some of those questions. I apologize if we weren't able to get to your question today. Please definitely take a second to write an email with your question to Troy, Dick, or Eleanor, and we should be able to get you a response. Again, if you have any additional questions after today's program, please reach out to us. Our contact information appears on the prior slide. We've also developed a COVID-19 resource page with the latest news and information surrounding the financial impacts of the virus. This resource is available on our website. And with that, we'd like to thank everyone for attending today's webinar. We encourage you to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. And please remember to complete the survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending, and have a great day.